Hi, this is Jay Hatfield, CEO of Infrastructure Capital, and this is Taking Stock.
I got one little headline. Time to rock and roll. 2 minutes to go here until the closing bell. Welcome to Taking Stock. I'm your host today, JD Durkin. A little bit of developing news in the last hour for investors to digest into the closing auction. The president a short time ago saying he is calling off a planned attack for Iran tomorrow. This coming after the heads of Qatar, Saudi Arabia, and the UAE, in his words, have asked him to, quote, hold off. We are off session lows. The S&P down about 0.1%. Peter Tuchman joins us now to kick off the broadcast for his take on the tape into the close. Well off the lows. It may not end in positive territory, but what'd you see to start the week?
You know, it's sort of a strange day. I think people are a little bit baffled and they really want to have some direction. After the incredible rally we saw all last week until Friday, right, which was, it could have been any number of things. It could have been sort of buy the rumor, sell the news over the China visit, right, that, you know, we rallied into that. And then, you know, did it hit off on every piston? Maybe not, right? A little disappointment with the deal about Boeing that maybe didn't come to fruition or whatever. But the sell-off was aggressive Friday, and that was significant. We closed at the low, and after the close, we went down another 20 handles. This morning, we were looking at a lower open, and then some news came out of whatever it was, an oil sanctions or something else. They came out with a little bit. So today felt like it was all about breaking news once again, which we haven't been. That rally was all over the fact that he postponed the attack, which he had planned an hour before. Right. It's a little bit giddy up on that.
Yeah, we'll see what investors have to say for NVIDIA earnings.
If you create catastrophe.
Time for the closing bell for the team at Oppenheimer. And there you have it, the team from Oppenheimer, ticker symbol OPY here at the big board, celebrating 145 years. The crowd goes wild, and investors, wow, don't call it a comeback, but the S&P 500 will finish down only 0.07% on this Monday, May 18th. The Dow eking out gains in a positive territory. Looks like up about 0.3%. Pretty strong tape, all things considered, for the Dow 30 components. The New York Stock Exchange Composite Index up about 0.5%, and the small caps, the hardest hit of the stock majors, down 0.6%. The Mag 7 in mixed territory. Microsoft, the outperformer. Tesla, the laggard. 3M, Salesforce, and Chevron, your big winners in the Dow, with your Dow 30 laggards, including Caterpillar, NVIDIA, and Amgen. Software stocks moving mostly higher on the day after a strong tape from ServiceNow. Semiconductors, however, after a very strong tape the last 6 weeks here on the street, cooling off a little bit today. Shares of Marvell down about 5% into the close. All the memory stocks safely lower. Seagate leading those losses down about 7%. The dollar slightly cooling. Last time I saw on the board, yeah, down a few basis points here after 5 consecutive days of gains. Let's bring in the one and only, a very good friend of ours here on the show and a very dear friend of mine personally. The great Chris Versace is the CIO at Tematica Research, here to kick off the broadcast after the closing bell. Chris, always nice to have you here, my friend. Thank you for taking the time. In your sense here, obviously we are off all-time highs after a little bit of selling pressure today and on Friday's session. But overall, Chris, why do you think the markets continue to climb even as consumer risks build and geopolitical risks build?
You know, JD, it's a great question, and I think a lot of people are kind of puzzled by it. You know, you'll hear people talk about the AI trade. I don't see it as a trade. I see it more as a prolonged multi-year investment. But, you know, so far earnings have been better than expected. The consumer has continued to spend. And I think some of the news that you were talking about recently today about, you know, maybe there's another possible solution to the US-Iran war. We'll see what happens. So I think there's a lot of positives out there. The worries that we've been bracing for, and I have them too, about the consumer, about consensus earnings expectations for the S&P 500, they haven't materialized yet. But I think that as we go through this week, we hear from some of the retailers, folks are going to be reminded about the duration of the war, inflation, and the follow-through risk, both for the consumer, corporate spending, and for consensus earnings expectations.
All right, so you mentioned retail. Let's jump ahead to there, my friend. Walmart, Target, Home Depot. What do you think they will say about the U.S. consumer, or is there anything you most hope we learn? about the U.S. consumer?
Well, so I think we have to deviate between the quarter that they'll be reporting, which, if we look at the retail sales numbers, including the April report, a little better than expected, consumers continued to open their wallets, benefiting, so we're told, by those tax refunds. But let's remember too, if we look at the monthly credit data, the consumer has been dipping deeper and deeper into their wallets. My concern isn't so much about the quarter they will report, the one that ended in April. It's more about the guidance that they're going to give for the current quarter and the back half of the year. So for that, we're going to want to watch three things: comp sales, what they have to say about their margins, and comments also about pricing action. Either have they taken it or do they plan on taking it? So those are the things that we'll be watching, JD.
Chris, before I let you go, I got to get your take on the big one for Wednesday, NVDA and Jensen Huang. Does NVIDIA still have to beat and raise in order to keep the so-called AI trade alive?
Look, we've seen a lot of announcements over the last several weeks with a variety of other AI chip companies, Marvell, Broadcom, Cerebras priced their IPO. So there's a lot of momentum there, but NVIDIA still needs to show that it is the, quote, king of the hill. And I think to do that, yes, it has to deliver a beat and raise, but not just a slight beat relative to the consensus. The market expects around $87 billion in revenue for the July quarter. I think it's got to come closer to something with a 90 handle on it so that it shows it remains a force in AI and data center. And I think they'll do it.
Great. Chris Versace, CIO at Tematica Research, my friend. Nice to see you as always. Best to your family. We'll do it again soon. Bobby, let's bring our viewers here at the top. Analyst calls that move the tape this morning here on Wall Street. We'll start with the latest from the team at Morgan Stanley, upgrading Lam Research to overweight, saying the stock in their estimation has more room to run. Price target now at $331. The stock up more than 50% so far here this year. Next up, B of A reinstating Salesforce as underperformed, saying there are too many negative catalysts for the software giant. 160 price target. Salesforce, the second worst performing name in the Dow so far this year, only behind Nike. Finally, Truist initiating coverage on Ross Stores as a buy. They cite industry tailwinds for the move. Ross up more than 15% on the year. They are set to report quarterly results on Thursday of this week. Bob, we'll take a look at a couple New York Stock Exchange notables that call the NYSE their home. And let's start with a look here at Viking. Shares hitting an all-time high last week. Today, Wells Fargo upgrading the cruise line to overweight. They say earnings are simply too attractive to ignore, despite the conflict in Iran. Price target 109, that's upside potential off these levels of about another 27%. And Bobby, let's swing around and take a look at TJX. Speaking of earnings this week, the parent company of Marshalls and TJ Maxx. I don't know about all of you at home, but I am proudly a Maxxinista. Truist initiating coverage on the stock with a buy rating. They call the off-price channel a very attractive value prop. Shares down 2% on the year. They will report quarterly results on Wednesday. The robotics arms race between the United States and China continues, especially after the meeting last week between Donald Trump and Xi Jinping. And Cheddar's very own Chris Castellino now brings us more on one American company trying to close the gap. Take a look.
I have seen people go from never touching a robot to programming their full system in 2 days of training. We've had people show up and then within 6 hours, they're ready to go. They're rearing, they're excited.
In a matter of minutes, using just an iPad interface, Jake walked me through how a first-time operator with no engineering experience can jog the arm along its 3 major axes, set positions, write a routine, and even run a pick-and-place cycle.
So it's as simple as that. It's like playing a Game Boy.
Traditional programming gets a robot to repeat the same task reliably, thousands of times, but the workplace isn't always that predictable. That's where StandardBot's AI layer comes in, and why the company is betting its future on what the industry calls physical AI.
Training through AI, rather than saving all these points, you either pick up a handheld device and you just do the job, or you're kind of using a joystick or a VR headset. You're just moving your arms like you would to do the job, and you're teleoperating the robot. However, you're just showing it what to do in any case, and that trains an AI model that can now do it autonomously. And the big deal here is these models, they almost feel like they can think. You'll show it how to handle a small object and a big one, and it can just adapt and handle what's in the middle, having never seen it before. And that ability to interpolate, that is the magic here. and the ability to self-correct. Like if it drops something, it just goes and picks it up again.
You need to have something capable of making decisions, doing dexterous movement, adapting based on what is in the work cell, what is around it, what is happening on the work surface. And so that's where our physical AI really comes into play.
And the data flywheel is just beginning to spin. Every StandardBots deployment contributes to a shared training dataset, improving AI models that benefit every robot on the network.
Think of it as you have your master welder who's been welding for decades, and he knows how to handle like a new part that comes down that he'd never seen before. And tolerance is a little bigger, he knows to slow down and weave, and he just gets the angle perfect. Like that's how these AI models are. Like they start to be able to handle everything and they've seen all the edge cases.
StandardBots' customer base spans a wide range of industries, from aerospace and defense to e-commerce, food production, and agriculture. And the company's backers also reflect that breadth. StandardBots has raised hundreds of millions of dollars with investors including Amazon, Samsung, General Catalyst, and a new physically focused fund called RoboStrategy. In 2024 alone, the company raised $63 million.
JP Morgan just did a report which said there's going to be a huge shift to the physical world. And obviously we saw a lot of the SaaS software stocks take a huge dive recently because, why? Because now it looks like with Claude Code, you don't have much of a moat just building software. And I think we've now seen a shift to go from investing in the software to, hey, now it's time for that next platform. And then that next platform is robotics.
When Evan Beard testified before the Joint Economic Committee of Congress last year, he laid out a 4-part framework for restoring American competitiveness in robotics.
Customers tell us bluntly that without our robots, they would shut down lines, close facilities, or lay off workers. The United States is not cost competitive in manufacturing today, but we can be with the right plan.
He recently testified again before the House Science and Technology Committee alongside Michael Robbins of AUVSI.
Any company that builds hardware here can tell you that if you source from China instead of making things here, it can be 5 to 10 times cheaper. And it's not just because of their lower labor costs, it's because of China's national investment in robotics.
Backed by a $137 billion state venture fund, subsidized below-cost Chinese robots are flooding into the United States to win market share, distorting the playing field to drive American robot manufacturers out of business.
We've seen this in solar. So in solar, China came in and they really subsidized it, and they were able to sell panels here, and it devastated our solar industry, and it put out of business a lot of our venture-funded solar bets, and we haven't recovered. And venture capitalists are not investing in solar today. It is a moment in time where a country like ours could go from being behind in manufacturing by making the right investments, by having the right incentive systems, by the government being clear that these are tools for workers to be more productive, that we can use these things to actually bring more jobs here and be more productive as a country, that I think that this can be a huge win.
America's next industrial revolution might just begin here, on this factory floor in New York. But the big question still remains. Do you think the US will catch up to China? Let us know in the comments below. For Cheddar, I'm Chris Castellino.
Welcome back to the show. John Medell joins us now for our next guest interview. He is the head of public policy at Injective. We'll talk Clarity Act and much more. Thanks a lot for being here. It's good to see you.
Thank you for having me.
So speaking of the Clarity Act, members of Congress finally moving from the crypto hearings part of this to actual rulemaking. It took long enough. What does the Clarity Act actually change, you think, first and foremost, for the crypto industry?
I think it brings clarity, per the title.
There you go.
No pun intended. But really it creates the rules for the road that allows us to be able to conduct business in a transparent and governed way. So that's very helpful for us to be able to continue to develop onshore and build the market and other products, if you will, onshore. That's a very, very important.
Big, high-profile bills like this are subject to lots of lobbying, lots of negotiations. Things tend to change over time. How is the bill that passed different from what was first presented a few months ago?
I think that what you see here is a much more concrete product. This is not just guidance or a framework. This really produces the rules of the road and gives the regulators an opportunity to opine and create more concrete guardrails, if you will. So this will not only turbocharge the industry, but also give people a lot more comfort and a lot of guidance on how to approach this market.
John, when I was a Capitol Hill reporter in Washington, members of Congress of both parties, they were really just learning about blockchain technology and this underlying crypto world for the first time. What is the big DeFi misunderstanding you think the industry still needs to do a better job conveying to lawmakers in Washington?
That's a very good point. We are in this moment in time where we've progressed, but more education is needed. We really have to be able to work with members of Congress, and some of them very unfamiliar with this new technology, to help explain the nuances and the benefits, as well as the risk of this new technology. And DeFi especially creates probably the most discomfort in some ways, so we really need to work and boost that educational level. And one of the things, in fact, we're doing at Injective is we are launching a policy institute to help in this conversation, this debate, if you will, because more education and more is needed, just frankly, out there and talking about these type of issues.
What are some of the top priorities for the Injective Policy Institute? And a bit more about it for anyone unfamiliar. And I wonder what you saw was missing in the industry that needed to be addressed.
I think there was a lot of attention, obviously, put in yield and stable coins during the debate the last few months. I think we want to make sure we cover some of these areas in DeFi that we're not focused on as much. So whether it be developer protection, tokenization, other areas, I think there's a lot of ground that could be covered and still should be covered. And there's a great opportunity here with a new Congress coming into place very shortly. I think new members of Congress, new blood, let's get in there and help educate them.
John Medell is the head of public policy, at Injective. Finally getting this thing over the finish line for the Clarity Act. Congratulations, thanks for joining us.
Not a problem, thank
Good
you.
to have you. Coming up here on the show, crypto's 4-day slump continues and the latest on big tech layoffs. A lot more taking stock coming up live after this. Welcome back to the show. Time now for the latest headlines in the world of fintech, crypto, and artificial intelligence. First up, the crypto majors are down for the day, with Bitcoin currently hovering right around 77,000. Next up, fresh labor data shows U.S. jobs most exposed to artificial intelligence are actually starting to decline, adding to growing concerns about AI's impact on the future of work. Finally, global crypto investment products seeing more than $1 billion in outflows last week alone, and that ends a 6-week winning streak amid a broader risk-off move across digital assets. Last week on the JD Durkin Show, I spoke one-on-one with the great Katy Perry of Zero Hash, and I asked her if the AI boom is about to become much more about Main Street than it is about big tech. Here's what she had to say.
I think it's both. It's very, very interesting, though. There's a lot of cognitive dissonance. So Anthropic rolling out the SMB tools. I mean, man, their product team is just shipping. But what it does is that, it evens the playing field. These small businesses are now having access to enterprise grade technologies. And you see this even with our world, with digital asset infrastructure, with, companies that can add stablecoin payments and other things relatively easily now. They're able to scale and compete with these big companies much faster. So for larger companies, it's a threat. For smaller companies, it perhaps helps even the playing field. The weirdness of it all is that, small businesses are the backbone of the American economy, but most Americans hate these data centers that are going up. There was a Gallup poll that came out yesterday. 70% of people don't want these in their backyard or behind their kids' schools. And so it's very awkward. These people are probably going to be using Claude and other tools to run their small businesses. A lot of them have, exposure to these types of stocks in their portfolios. A lot of them are doing well with those types of stocks. At the same time, they don't want these big honking, data centers where the shopping mall used to be. And it's really interesting because you think of this stuff as being in the cloud, but there is a physical element. And where does that physical element go? Middle America.
So we had the Gallup poll. You sent me this last night, and I love this. Well, I don't know that I love all the details of it, but it's a fascinating kind of story. 71% of Americans oppose building AI data centers in their area. Everyone seems to want faster AI, but nobody wants the massive power and the water usage.
Yeah.
Is this basically like a corporate NIMBY problem?
Yeah, I don't know. It's awkward. I'm very fascinated by where the conversations we have at the stock exchange or, in these tech conferences where they intersect with real people. I was just upstate last weekend for my cousin's wedding, and it's always refreshing to be up there, talking to a family friend who owns a restaurant and what he's going through. And so you start to see, when tech starts accelerating and adopting, we're talking about it here up here, and then it gets to the level of how it impacts people. And it creates some somewhat, for lack of better words, awkward situations where you're like, I want NVIDIA in my 401k, but I don't necessarily want this thing, overtaking a ranch down the road.
Let me get your take on tech layoffs. Cisco, just the latest name to cut thousands of jobs while ramping at the same time AI investment. I feel like that's what we've heard from a lot of these big earnings calls. It's like, hey, our CapEx is through the roof, and also we are laying off employees. This comes after LinkedIn recently said planning to lay off 5% of their staff. Next week, 8,000 Meta employees, that's about 10% of their global workforce, sets to get laid off May 20th, which is ironically the day of NVIDIA's earnings report. Is this kind of just the current reality for the AI economy?
Yeah, I think there's going to be a lot of turnover in these white-collar jobs. We were just, as I said, we're at a leadership strategy session this week talking about large uptick in applicants and interest, because we're hiring like crazy. If you're looking for roles, we have them on our website, zerohash.com. But there is going to be a lot of rotation out of these bigger companies that have become bloated over time. And I think LinkedIn's a great example. If you feel for the people that were affected, but if you've been in New York for long, it's an inside joke that LinkedIn's platform hasn't changed all that much, and they've continued to grow as a company. There's other companies that have become sort of a punchline. DocuSign's one of them. You see all the time on X. Why do thousands of people work at DocuSign? So I think there's going to be a rotation out of some of those larger companies. But back to my original point about some of these techs helping other companies scale faster, you now have, early stage, growth stage companies that using these technologies, they can grow faster, and hopefully those can absorb some of the job opportunities that are being lost to the legacy players.
I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money, where we take companies that look simple on the surface and explain why the economics actually work. Today we're going to be talking about Ownwell, because this is a fintech at its most elegant, a business that only makes money when customers win. Property taxes are one of those costs people know that they're paying but almost never really question. And for most homeowners, navigating the appeal process is confusing, time-consuming, and easy to get wrong. That's exactly where Ownwell comes in. Ownwell helps homeowners challenge and reduce their property tax bills by managing the appeal process end to end, using a mix of software, data, and local expertise. So let's talk about how Ownwell makes that money. The core model is performance-based pricing. Ownwell only gets paid if it successfully reduces your tax bill. No savings, no revenue. When savings happen, Ownwell takes a percentage of it. That alignment matters a lot. There's no subscription friction, no upfront risk for customers, and no incentive for Ownwell to push unnecessary appeals. The business only works when the outcomes do. Second, scale through software. While the appeal process is local, the workflow isn't. Ownwell uses technology to standardize filings, manage timelines, and analyze assessments, and run thousands of appeals efficiently. That's how a local by nature process becomes a scalable business. Third, repeat economics. Property taxes reset every year, and once a homeowner has a good experience, the churn is low. That turns what looks like a one-off service into recurring annual revenue. Here's what makes this model unusually strong. Homeowners are extremely fee sensitive, but very open to outcome-based pricing. Only pay if you win cuts through skepticism instantly. So why Ownwell? Why are they having this moment right now? Because home values have surged, and when valuations rise, tax bills tend to follow. That creates a massive pool of homeowners who are paying more than they realize and are suddenly motivated to act. That demand showed up directly in the company's funding. In February 26, Ownwell raised a $50 million Series B as investors leaned into a very clear thesis. Consumer fintech that aligns incentives and avoids upfront fees scales better in tighter economic environments. This wasn't a bet on shiny product. It was a bet on trust. So where is the moat? Two things. Data and credibility. Over time, Ownwell learns how different jurisdictions behave, which appeals succeed, and where outcomes are most likely. That improves win rates and improves unit economics. And once homeowners trust a service that deals directly with taxes, the trust is extremely sticky. Ownwell doesn't monetize confusion, it monetizes relief. And that, my friends, is how Ownwell actually makes money, by turning a universally disliked expense into a shared upside opportunity. Not through complexity, not through fine print, but through incentives that finally feel fair. And that is that. If there's a fintech company you'd like us to feature, drop it in the comment below. Maybe I'll make the cut. In the meantime, back over to you.
Tomorrow morning here on Wall Street, we will get the latest quarterly results from a few New York Stock Exchange listed hometown favorite names, including Home Depot and Amer Sports. And this time tomorrow after the close, the latest results from Cava as well as Toll Brothers. Your final tail of the tape for this Monday, May 18th, the S&P down, the Dow higher, the small caps moving down about 0.6%. The crypto majors down for the day with the Mag 7 tech stocks in mixed territory. 3M, Salesforce, and Chevron, your strongest performing names in the Dow Jones Industrial Average, and your Dow 30 laggards, Caterpillar, NVIDIA, and Amgen. Thanks for watching today's edition of Taking Stock. Have a good Monday night. We'll see you again tomorrow.